When we look at the past 20 years, the biggest problem for markets is that there are almost 2 generations of traders that have only seen expansionary policies. And when those traders have only seen the market go up with low rates and high liquidity, they expect that low rates and high liquidity will remain forever. Furthermore, the big challenge as well is that when a mentality such as buy the dip, buy the most cyclical stocks, buy the most aggressive and extremely valued assets in order to pick the higher beta exposure to the market, expecting to generate higher returns with monetary expansion, that policy, that strategy, which has worked, may not work the next time. And the reason why is because the next time that expansionary policies are implemented, it will probably be because there is a crisis, not because there is a recession. And therefore, exposure to the cycle and exposure to beta may be very dangerous, because what we could be facing would be stagflation, not an environment of recovery, of strong recovery at all. Inflation is very difficult to combat, and certainly very difficult to combat when governments are not reducing expenditure. Think about this. If the government weighs about 40-50% of GDP and continues to spend in what they call anti-inflation measures, what ends up happening is that they create more inflation, because what they're doing basically is issuing more units of currency and consuming more monetary units. The latest expectations from brokers are showing that persistent inflation remains one of the core problems of the global economy. If we look at the United States, this graph by JP Morgan shows that core inflation remains very elevated, and stubbornly so, in an environment that should be showing a very aggressive reduction in core inflation. In fact, the only real impact on inflation comes from the reduction of energy prices, which means that there may be some improvement in GDP estimates because inflation is disguising some of the challenges of the economy, but not because the economy is strengthening either in productivity or in real improvement of the private sector. Producer prices are rising again, and this is happening in a time in which commodities are actually not working the way that they probably would have in an environment of improvement of demand coming from the China reopening. Commodities are actually much weaker, and that shows that rate hikes are working. The impact on commodities coming from the monetary cycle is much higher, which means that despite the challenges of supply and demand, which are evident, there is a strong demand and there is the problem of underinvestment in many of the commodities added to a tight supply. That is absolutely true. However, rate hikes mean that taking positions in commodities, that storing, that financing the storage of commodities is much more expensive. Therefore, that it means lower of all of that monetary side, and therefore lower prices in the marginal part of the pricing, in the spot price. However, if we look at the increase in producer prices, the second wave of inflation coming from services is very evident in this graph coming from Bloomberg Economics. So we need to pay attention to that, because services are actually bouncing back, and in some of the economies they're back in robust levels of expansion territory when we look at the PMIs. Inflation is always monetary mismanagement. As Professor John B. Hearn always says, what we need to pay attention to is monetary aggregates. And monetary aggregates are actually falling. The level of money supply growth is significantly lower than what was initially expected at the beginning of the year. However, markets are reasonably optimistic. So something doesn't add up. And the reason that for markets to be so optimistic is fundamentally because the expectations of a pivot coming from central banks is taking further stronger levels of hold in investors' minds. When we think about that, well, we need to also think that if monetary aggregates are showing a significant decline, yet core CPI is rising, and the more stubborn, the less volatile parts of CPI continue to rise, then Fed pivot and central bank pivot could be a very dangerous combination. So the idea that everything can be disguised under the umbrella of the Ukraine invasion doesn't hold up anymore, because commodities are weaker relative to 2022. And all of the commodities have been weakening because of rate hikes. So don't trust this bet on monetary expansion and at the same time inflation coming down aggressively. It's very difficult for it to happen. Rate hikes do have an impact on credit impulse. This graph by Bloomberg shows how the credit impulse in the Eurozone is weakening, and it's weakening fast. It's showing that the difficult process of soft landing that central banks want is difficult. It's very challenging to achieve. Very challenging to achieve because, on the one hand, policy remains way too accommodative to combat inflation in a drastic way. Balance sheets have barely changed, reduced very, very little compared to how quickly and how much they grew, and rates remain below the curve in most cases. So, behind the curve. So, an important factor is that, on the one hand, policy remains extremely accommodative, and on the other hand, that rate hikes are having an impact on credit impulse. So, very difficult to play this soft landing theme, and something that we need to look at, because if central banks let inflation go on and rise faster in the second part of 2023, there could be a huge backlash in markets similar to the one that we saw in 2022. The S&P 500 has been flat for almost 12 weeks in an environment of risk on from investors, from markets, and with a generalized perception of strengthening of the global economy. A number of factors are to play in this strange movement. The first one is obviously that the reason why the S&P 500 is relatively weaker compared, for example, to European stocks is because this year technology stocks, which led the equity market in the period of monetary expansion and the period of low interest rates, those tech giants are actually bringing the performance of the S&P 500 lower. On the other hand, very aggressive, bullish expectations about the European recovery are making the European stocks rise faster. So there are a number of things to play here. First, because tech giants are probably going to end this process of rate hikes in a stronger position after reducing the excess in labor force, after streamlining their operations, etc., and continuing to be global leaders. Whilst I find it rather challenging to believe that those so-called value sectors don't become yet again what they have historically been, which is value traps, because the earnings growth profile is very limited, if existent at all. We have mentioned a number of times how monetary policy is now the biggest factor impacting commodities. But we cannot ignore the fundamentals, and the fundamentals remain strong. The IEA has revised global oil demand up and assumes that the biggest driver of this oil demand growth in 2023 will be China, which accounts for almost half of the total growth in oil demand for the year. This comes in a period in which underinvestment continues to affect the supply chain, while we have tremendous pressure from political bodies trying to force oil companies not to invest in oil and gas. Now, I find it very ironic, to be fairly honest, to believe this idea that on the one hand politicians are demanding lower oil and natural gas prices while trying to ban or limit the investment in oil and natural gas. Obviously that will come back to bite the market at some point. However, in 2023, so far, the monetary aspect is much more important than the supply-demand scenario. But watch it, because the supply-demand picture is tight and is getting tighter as inventories are reduced. So there's a case here for a short to versus long-term bet. Bonds have recovered very fast in 2023, and now it's time to take profits, particularly on duration and on those bonds that are more linked to the cycle. Certainly, I would not be particularly impressed with the idea of purchasing sovereign bonds from the European Union, because they remain extremely expensive compared to the fundamentals of solvency and liquidity, added to the reality of inflation. So unless we see a realistic improvement in inflation estimates, I am not particularly fond of the idea of adding duration, let alone European sovereign duration. Gold is, in a certain way, correcting a little bit after a strong beginning of the year. Main reasons: stronger dollar and the profit-taking from some investors. However, the supply and demand scenario remains extremely bullish. More importantly, we mentioned a few times the monetary aspect on commodities. And in the case of precious metals, the monetary aspect is even more important. Central banks are purchasing more gold than ever. Furthermore, in terms of a real reserve of value and a real way of combating the risk of stagflation, gold is certainly a much better alternative than other assets out there. Crypto assets were massively maligned in 2022, to the extent that between 2018 and 2020, we heard from clients all over the world all the time why we didn't buy cryptocurrencies, why we were not investing in cryptocurrencies aggressively. And it's interesting, now that they're bouncing back, the questions have stopped. Nobody seems to be interested, and that is a good sign. It is a good sign when you don't hear so many retail investors and so many people who are not informed asking about an asset simply because it goes up. So if there is actually interestingly a bullish scenario for cryptocurrencies, and certainly for Bitcoin, which is showing a big difference relative to other crypto assets, it is precisely the fact that volatile, less informed, and risk-prone traders are starting to be away from the asset. And that may help in the midterm. What also should help in the midterm is if cryptocurrencies start to really be an alternative to US dollar liquidity. We have said it a few times in this program. I'll say it again. Until cryptocurrencies, and Bitcoin in particular, don't find a way to have their own liquidity in an environment in which the US dollar raises rates or reduces the balance sheet of the Federal Reserve, then it's going to be very difficult to see it as anything else than an asset that moves with and alongside tech giants, high-risk tech, etc. Periods of high inflation are always followed by periods of disinflation. The fact that periods of disinflation happen should not be a reason to remain accommodative in terms of monetary policy. This is the problem. The problem is that people perceive that tightening and hiking rates is what creates a crisis. No, it is not. What creates a crisis is the accumulation of risk coming from investors that take the opportunity of low rates and high liquidity to massively bloat exposure to very expensive and very aggressive and risky assets with the idea that monetary policy is going to disguise it all and elevate valuations automatically. So the idea that there may be some disinflation should not be in any shape or form a way of thinking that central banks should actually continue with the insanity we have seen in the past decade. The reality is that what we need to do is to return to sound money, and we are very far from that. The United States-China conflict is not getting any better, and it's certainly going to continue to erode potential growth all over the world. Trade barriers, all different types of tariffs, regulatory limits, etc., are going to continue putting pressure on emerging economies that find it more difficult to grow, to improve their exports. And protectionism is not a story of 2016 or 2017. Protectionism started way before, and very significantly, precisely because of at the beginning, limited, but now elevated tensions between the United States and China. The European Union also implements protectionist measures. How? Through the environmental excuse, among other things, but there are huge trade barriers in sectors like the automotive sector and the agricultural sector, etc., all of them, between subsidies, etc. So I find it quite interesting when I read that the European Union is going to respond to the United States subsidy program, which is fundamentally coming from tax deductions, with a massive subsidy program that comes on top of other subsidy programs. You see what I mean? What I'm talking about is that what we're seeing is an environment in which protectionism is taking hold and becoming not something that is an anecdote, but is the norm. And putting brakes on trade is inflationary. Putting brakes on the improvement of supply chains and commerce between nations is certainly negative for growth, negative for productivity, and bad for consumers.